All right, I'm going to kick things off. Morning, everyone. Welcome to the Lumsden and McCormick One Big Beautiful Bill webinar. There's lots of interest in this, so I'm going to quickly run through some housekeeping and then I will turn it over to Megan Morris Smith, who's going to kick the webinar off. So the webinar will be recorded. We will be sharing the recording with everyone, so you'll get via email a link to the webinar that will be posted on our website. So give us a few days and we'll get that over to you. Both chat and Q&A are enabled. If you have any questions for me as the moderator, put them in the chat. Any questions for the speakers, please put in the question box, and we were going to hold questions till the end. So just put them in the like I said, the Q&A box, and then we will answer them once all three speakers have gone through their presentation. We are offering 1 hour of CPE credit for all the CPAs. So if you would like to get CPE credit, make sure you answer all 4 of the polling questions and you complete the survey at the end. Both of those are required to earn CPE credit. You will get an email directly from our CPE provider called LC Vista, and you can expect that email within 15 to 30 days of this event. And like I said, the webinar survey will launch immediately upon the closing of this session. Okay, so I'm going to get to introducing our speakers. I'm doing this in alphabetical order. Hayden Cole is a manager in our tax department, and he specializes in international tax for both businesses and individuals. Megan Morris Smith is a principal in our tax department, and she works with both businesses and individuals, and she has a specialization in R&D tax credits for corporations and partnerships. And Amanda Oranowski is also a tax principal. She specializes in corporate tax and family wealth and estate planning. So I'm going to link their bios in the chat. So if you want to look them up, you can. Otherwise, I'm going to turn it over to Megan.
All right, good morning, everyone. Today we're going to kind of cover a lot of topics in a variety high level kind of way. So if you ever want any more detailed information, feel free to reach out to your Lumsden advisor or reach out to one of us, and we're happy to send you any more information. We're just going to kind of keep it as high level as we can because there's a lot of content to cover in just an hour. For right now, feel free to drop any questions in the chat. We're going to kind of do questions at the end, but maybe if we get time, some of us can answer questions kind of as we go through the webinar. So sort of kicking things off, our agenda today. So I'm going to be covering the business incentives and the impact of those. Then I'm going to turn it over to Amanda, who's going to cover individual provisions and planning for that. And then we're going to turn it over to Hayden at the end, who's going to kind of cover international updates, tax credits, other kind of provisions, and then also as well as some kind of employer specific provisions. And then we'll all be available for Q&A at the end. So kind of kicking things off with those business incentives, I'm going to kind of cover some of the major ones. I think when you think about the business incentives, it's high level, good to think about what kind of the administration's thoughts have been for this law being passed. And a lot of that's kind of bringing production or industry sort of back to the United States and sort of incentivizing that development. So I think a lot of the tax cuts or proposals really emphasize kind of bringing activity back to the US and expanding your operations in the US, and then that has favorable benefits for you. So kind of the first big area that we're going to cover is depreciation. So for those of you that are familiar, there's a couple different kinds of tax depreciation. One of them is Section 179. So after the new law, this deduction limit has increased to $2.5 million with an asset phase out threshold raised to $4 million. These two amounts will be adjusted for inflation, and they're eligible for kind of property that starts your in your tax year after December 31st, 2024. So if you're a calendar year taxpayer, that means for 2025, you'll be able to use it. Your fiscal year taxpayers, you won't be able to use it kind of until your next fiscal year that's up and coming. And then these adjustment limits every year will be adjusted for inflation. So this is going to be huge. I know kind of Pre the law, the limit was a $1 million limitation with a $2.5 million phase out. So this has been adjusted over the past few years for inflation. So for 2025, the deduction amount was set to be 1.25 million, and the phase out amount was around a little over 3 million. So you can kind of see like just this deduction amount for 2025 alone is going to basically be double what it used to be. So if you're kind of that mid-size or small business that's going to have property phased or placing property in service under the threshold, it's really beneficial for you to kind of be able to use this Section 179 new increase. However, you'll kind of see just the phase out limitation. It's truly trying to now target maybe some more of those smaller businesses by kind of putting that threshold at 4 million, even though the whole cost has gone up that you can actually expense. The next kind of depreciation where there was changes was bonus. So bonus depreciation over the past few years has been phasing out. So for example, in 2023, we had 80%. 2024, this year, you could only use 60% of your bonus depreciation. In 2025, this was scheduled to drop to 40%. However, with the law, there's now 100% bonus depreciation reinstated permanently for qualifying property. So this property, there's a lot of tricky dates in the law. I think that's probably one of the more confusing parts of it. It has to be placed in service after January 19th, 2025. So starting January 20th, any assets placed in service in between that time would still, January 1st to January 19th are still going to be subject to those 40% limitation amounts. So usually, we don't see clients placing too many assets in service in early January. So we're not expecting a huge limit here. Just kind of noting, if you are a fiscal year entity, this is a little bit different from the 179, where this applies to any property kind of now. So if your fiscal year doesn't end, until June or August, September, anytime you have assets in 2025, you're now allowed to use these new bonus depreciation rules, which is a little bit different than the 179, which might be a little delayed if you're a fiscal year entity. So that's very helpful. And then there's also this new category of depreciation that was placed in service. And I think this will be a really powerful one for our region, especially. And it's a new category of asset called qualified production property. So what that's going to kind of be is non-residential real property used in manufacturing, production. So they've specifically kind of said production is going to be agricultural production or chemical production, and then refining as well. So what this means is any real property that you're using for manufacturing, if you're building a new facility, something like that, it's now going to be eligible for 100% bonus depreciation. Just kind of noting a few different things. The original use, you have to originally use the building and place it in service in the US. Construction is going to have to start after January 19th, 2025 and before January 1st, 2029. So again, kind of keeping in mind of those dates. And then it's going to have to be placed in service by 2031. So right now, this new category does kind of have some time limitations where the 179 and the bonus are both permanent. We're going to need a lot more guidance for how this works in terms of, lessor-lessee relationships, how we can structure entities that way, especially with related party leases. And then also, just kind of clarifying what administrative use will be. Right now, kind of the way the law is written, it makes it sound like the whole facility would need to be just manufacturing. So any sort of offices, administrative functions that are not related, that are part of the building, it's going to be interesting to kind of see how those are treated, and we'll get more guidance later on. But if you're looking to expand your, manufacturing or production facility, this is going to be a huge benefit for you. Just kind of noting with all of these depreciation changes, 179 bonus, and even this QPP, states all have different treatments of how they follow this. So some states might follow federal, some states, might allow 179, but not bonus. That's what New York does. And then some states are kind of all different combinations. So just be careful when you're thinking about like, I'm going to be able to get all these great depreciation deductions for equipment that I'm placing in service, that it might just truly depend, on the state. So verifying that with your Lumsden rep as well as you're preparing for those. The next kind of major benefit for businesses is going to be the treatment of research and experimental expenditures. So I kind of put a spreadsheet. This has sort of been a little a roller coaster over the last couple of years for how these costs have been treated in the US. So between domestic and foreign, so before 2022, under the Tax Cuts and Jobs Act, or before the Tax Cuts and Jobs Act, you were able to immediately expense both foreign and domestic R&D. You could optionally choose to capitalize it if you wanted to. I've never seen that done before, but most people chose to immediately expense everything. And then between tax years 2022 to tax years 2024, you started to need to mandatory capitalize them. And this kind of came about as part of the Tax Cuts and Jobs Act. It was delayed a little bit through COVID, but then it sort of came into effect for 2022 to 2024. So for domestic costs, those had to be capitalized and amortized over a 5-year period, which is kind of the regime we're in right now. And then foreign costs were over a 15-year period. So this was really hurtful to a lot of clients and taxpayers that had R&D activities. So think your manufacturing, your tech niches, pharmaceuticals, all those industries were kind of really hurt by this. It was very expensive for them from a tax perspective and kind of hurt, kind of bringing in incentivizing R&D activities in the US. So now going forward, starting for 2025, for domestic costs, you'll be able to immediately expense those. They've added back a new optional capitalization and amortization regime. And then for foreign R&D, you still have to capitalize that over the 15 years. So this is kind of where it's coming from with my initial comments of, keeping things in the US, that's kind of getting incentivized here with R&D credits. So kind of expanding a little bit on this. What does this mean now if I had to capitalize costs between 2022 and 2024? So if you're a large business taxpayer, which in this case is going to mean over 31 million in gross receipts, you're going to have the following options. So any unamortized basis between 2022 and 2024 that you still have, you can either take that all as a deduction in 2025, or you can split that 50-50 between 2025 and 2026. Or if you wanted, depending on how this expense interplays with other tax provisions that you have, you could just continue, choosing to keep that amortization going over the rest of the useful life of it. So it's really beneficial here and could kind of be important for planning too, to make sure you're adjusting any estimates that you have or things like that to kind of account for this huge deduction that you're going to be able to take. And then if you're small, you kind of get those same options of expensing everything in 2025, expensing it between 2025 and 2026, or continuing, or you could potentially go back and file an amended return. We need to have a lot more guidance with this. And if you've ever filed an amended return recently in the last few years, you know how long of a process that can be with the IRS. So we're kind of thinking as a team, it's likely going to make sense to kind of go with one of those first 3 options and not amend the return. But we just wanted to put it out there that if you're a small entity, there could potentially be an option to go back, but we need to wait for a lot more IRS guidance to make sure that we're not doing something that is a bad tax position, because there's a few different rules of how things interplay together. And then kind of moving on to our third big thing is interest expense. So this one's actually pretty easy. Before the last couple years, you used to be able to add back depreciation and amortization expense into your calculation for how your interest deduction was computed. However, that switched to just kind of being EBIT before. So now it's going back to EBITDA. So it's actually a favorable change. It'll lead to an increased deduction for businesses, especially those with a lot of depreciation and amortization that were really kind of hurt by this limitation. So this begins in the 2025 tax year. So that one's pretty easy. It'll help a lot of people for sure, especially with the high interest rate environment that we're seeing lately. But it is pretty straightforward to get. And then there's going to kind of be some unfavorable changes. These are going to impact mostly taxpayers with international, or if you have some capitalized interest. This is a little bit more nuanced, so I'm going to kind of keep it high level and just sort of quickly move through those. And then our last sort of big change that I'm really going to cover for businesses, aside from just some high level stuff, is qualified small business stock. So for any stock that was acquired after 7/4/25, which was the date that this bill became law, if you've acquired qualified small business stock, you can have 100% exclusion if the stock was held for 5 years. And then they also added new limitations of 75% over 4 years or 50% exclusion over 3 years. So this gain exclusion, it was, $10 million. It's now increased to 15 million that will be indexed for inflation. And then the limit on gross assets, it has increased to 75 million from 50 million, and that will be also indexed for inflation. So this was kind of a nice benefit of, sort of incentivizing investing in US businesses that qualify for this qualified small business stock. It can be a really helpful tool to mitigate future tax impacts of gains. And then there was a small change on C Corporation charitable contributions. There was just a 1% floor added for the deduction. And the max amount is still 10% of taxable income. Those charitable contributions will be carried forward for up to 5 years. Also QBI, I just wanted to make mention, this has sort of stayed the same as what it was, but it was set to phase out after 2025. So just kind of knowing it's a positive in the sense that this deduction was going to go away, but now it's here to stay. So that's very helpful. And then also for PTET, there was a lot of proposals in the bill that was a little bit confusing, that there was going to be some kind of harmful changes for PTET. That was ultimately all left out of the bill. So we just wanted to kind of make a high level mention that if you've used the PTET deduction over the past few years, that's basically stayed the same. And then opportunity zones, these we're going to kind of phase out as well. We're going to need more guidance, but basically there's going to be some changes that's made permanent. You'll still have to recognize your gain deferral as of 12/31/26 if you originally made it, but starting in kind of 2027, there'll be new zones, new kind of definitions of rural zones and low income communities to kind of make sure the program stays tailored to what it's supposed to be. So if you've taken advantage of those, there'll be more guidance to come kind of on those changes. So then we're going to kind of close up the business section with a polling question, and then we'll move on for Amanda for individuals.
Okay, everyone, here is the first polling question. Which event happened on this day in history, August 26th? I won't take the time to read them all, but if you guys could all fill that out. Again, the polling questions are required for those who are requesting CPE. And if not, they're just fun to play. So we've got about half of the people participating. So just see what the answer is here. Once we have about 75% participation, I will close out the poll so we can move on. All right. I'll give it another second or two. All right, the answer is actually all of the above, and we'll actually share the questions in the presentation so everyone can just see what they were. But all of these events did occur on August 26th. All right, I'm gonna end that. Most people did answer all of the above, so turn it over to you, Amanda.
Oops. All right, 1 minute. I am figuring out how to share my screen here. Okay, we should be sharing now if we are not already. I'm going to be covering the individual provisions and planning specific to OB3. When we were watching what was going on in Congress, when OB3 was being discussed, we were really looking to see if the provisions of TCJA, which had been the most recent tax legislation, were going to be extended or not. So we were looking then to see, will they be extended? Are they going to be extended as is or with modification? So this first thing that we're looking at here, the individual tax rates, these were extended as is under TCJA. TCJA had lowered the rates, and those are now made permanent. So previously there had been a 39.6% top tax bracket. We're now looking at that at 37%, and that should stay there going forward now. And then the standard deduction, this is something that was made permanent under OB3. Prior to TCJA, if you remember back to, your 2016, 2017 tax returns, the standard deduction was a lot lower. For a single individual, it was about 6,000. For a married filing joint taxpayer, it was 12,000. So TCJA increased those quite a bit, and OB3 made that permanent. So now for a married filing joint taxpayer, they are looking at a standard deduction of 31,500. It did also keep the suspension on personal exemptions. That was something that happened under TCJA. If you remember way back, there used to be, it was about $4,000 per person. You could take an additional exemption for on top of your deduction. That was suspended under TCJA and extended through OB3. So now our standard deductions are these numbers that we see here on the screen. There is an enhanced deduction for seniors. So if you're over 65, you can claim an additional $6,000 deduction per person. That is phased out if you hit certain AGI thresholds. And a full phase out at $250,000 of AGI. To take this one, you have to be, if you're a married taxpayer, you have to file joint. This becomes effective for the 2025 tax year and is set to expire in 2028. The SALT cap, I think this was probably one of the most discussed. So if you have not heard, if you live under a rock, the SALT deduction was increased to $40,000. Under TCJA, a SALT cap was implemented, making it $10,000 is what you could deduct. This is going to increase 101% annually. But if you do have AGI of over 500,000, there's going to be a phase out of that SALT deduction that is allowed, not below 10,000. So it decreases at a rate of 30% of your income exceeding 500,000. So if your AGI in your tax return was 550,000, that $50,000 excess is going to be subject to a 30% reduction. So some quick math, $50,000 excess at 30%, your SALT cap is reduced by $15,000. It would bring it from 40,000 down to 25. So that is something that as you are working on year-end planning with your advisor that we will be looking at is to see where do you expect your AGI to be and how is that going to impact the SALT deduction that is allowable for you. This increased deduction is effective for the 2026 tax year. So for 2025 taxes, you're still limited to a $10,000 deduction. And it is currently set to revert back to $10,000 in 2030. I'm sure we will see continued talk and extensions around this as well, though. Charitable contributions. This is something new here. For itemized filers, they imposed a 0.5% floor on charitable contributions. So, previously, if you had contributed, $10,000, you would get a $10,000 itemized deduction if you qualified. Now they're implementing a 0.5% floor. So we have to look at your AGI, and there's going to be an exclusion of the first 0.5% of things here. And that is effective for 2026. What they did add back in, which is a nice benefit if you are taking the standard deduction, is you can deduct charitable contributions still, even if you're not itemizing, $1,000 for a single taxpayer, $2,000 for married filing joint. That also comes into play in 2026. So this is an area where we're encouraging people to maybe be strategic, work with your advisors. If you want to get extra charitables in without worrying about that floor in 2025, that's something to discuss with us. And, otherwise consider bunching contributions. If you can, make 2 years worth of contributions, only have to exceed that floor once, that's going to help you to maximize the gifts that you are making. The mortgage interest deduction. This is something that we saw come into play. Sorry, I'm going the wrong way. Under TCJA, and OB3 extended it. So if you get those little mortgage interest statements in the mail now, you probably have seen they added on there what is the current balance of your mortgage in the year that it was taken out. That's all information that we need now to calculate your mortgage interest. So if your mortgage debt that you took on is in excess of, let's say, $1 million. If the debt was incurred between 2025 and 2029, we will need to limit the mortgage interest that is deducted. So if your mortgage was 1.5 million, we have to calculate a ratio to reduce the mortgage interest that can be deducted on your Schedule A now. They are now also allowing mortgage insurance premiums as allowable deductions. Those were excluded in the past, and now that is something that we can include. There is still no longer a deduction allowed for interest on home equity loans that are not used to improve your home. So if you're using your HELOC to put on a new roof, put an addition on your house, we can take that interest, a deduction on your return. If you're using it to, help send your kid to college or you do something else, that mortgage interest we cannot deduct on your tax return. So you may see some extra questions from us around that to make sure that we are getting it right on your return for you. And that becomes effective in 2026. Casualty loss deductions. This was something that we did see under TCJA, as well as some limitations on these deductions. Previously, anything, if heaven forbid, I have a fire at my house, I would have been able to calculate a casualty loss deduction on my tax return. TCJA limited that to losses that were a direct result of a federally declared disaster. OB3 extended that, but then also expanded it to include state declared disaster areas as well. So, this is something that we see. I know we're based in New York here, but a lot of our clients and individuals that we work with might have vacation homes in Florida or other places where natural disasters are a little more common. So this is something that we will be kind of keeping an eye on to see if there is a claim to confirm that it was in one of these disaster areas before we can take that deduction for you. Wagering losses, not much here, but it is something that people do ask about. We're now limited to 90% of your losses to the extent of gains. And then miscellaneous itemized deductions. These previously used to be if you were paying, fees to your broker, you could deduct that. There was a whole host of other items as well that you could calculate an itemized deduction for. These were suspended under TCJA. That suspension was made permanent with the exception of unreimbursed educator expenses. So, if you do have those expenses, keep tally of what you have and it would be included on your Schedule A when we file for you. And then I have here, this is a copy of the Schedule A. I've been referring to it a lot at the beginning of this presentation here. This is the 2024 form, and I kind of just want to walk through and show, illustrate right on here, what are the changes that are happening. So medical and dental, this continues to be limited by the 7.5% floor. This has been here for years. I think they have played around with this number a little bit, but still set at 7.5%. Then, let's see, how do I do this? Moving on to taxes, this cap was increased from 10,000 to 40,000 under OB3 with that phase out if your AGI is over 500,000. Interest paid, if the debt exceeds $1 million, we will have to calculate a limitation on here when we calculate that. Charitable contributions, I expect they're going to add a line on here similar to the medical and dental expenses up top, where you're going to see it limited by 0.5%. This is something new that we haven't seen before, but that's what we expect to see. And then that will include the carryover from prior year as well. So we'll be putting in your charitables, your carryovers from prior year, and then calculating the 0.5% floor of AGI. I wouldn't be surprised now that the mechanism exists on the return. We've never seen it before. If that 0.5% does change over time, that we may see that increase or decrease just depending on if they need to raise revenue or not. And then casualty losses, these are going to continue to be limited here, but the limitation is expanded to state declared disaster areas as well. And then miscellaneous deductions continue to be suspended with the exception of the educator expenses. So you look at this, honestly, it's become a little bit of a minefield as we're going through. It used to be you paid taxes of X and that's what you deducted. You paid your mortgage interest, that's what you deducted. Now we really have to look at the limitations, the phase outs, and see, is there any way that we can be strategic about making sure that we are maximizing your total deductions? So after we get through all that, we're going to get to your total itemized deductions at the bottom here. I'm really thinking of this as now, this is your total itemized deductions allowable, because there is now as well an itemized deduction limitation that we have to calculate if you exceed certain income thresholds. So if you do exceed certain income thresholds, your itemized deductions will be reduced by 2/37 of the lesser of your itemized deductions or your taxable income exceeding the 37% tax bracket. And that will then allow us to calculate your total itemized deductions deductible on your tax return. So a lot of different things happening here. The name of the game really is going to be planning and, working with your advisor to understand how is everything going to impact, you specifically in your tax situation. The AMT tax, OB3 does permanently preserve the higher exemptions enacted under TCJA. So this table here kind of lays out prior to TCJA, what were our phase out thresholds and exemptions under TCJA and then under OB3. So what we're seeing here is that effective for the 2026 tax year, the rate of phase out increases. So a lot more taxpayers are going to be pulled into AMT than were previously. So even with all of the changes to itemized deductions, we're going to see more people subject to AMT tax, which may negate those itemized deductions that you did qualify for. So again, a lot going on here that we want to, make sure that we're planning with you to see where you're going to be at for the year. Auto loan interest, OB3 is now going to allow a deduction of up to $10,000 on interest paid for new vehicles, with the caveat being that these need to be assembled in the US. There is a phase out if your AGI exceeds 200,000. If you're filing a joint return, you don't need to itemize to claim this. You will need to report your VIN and confirm that it is a US assembled vehicle. That's really the key on that one. And then for tip income, I know Hayden's going to talk about this a bit with the employer provisions as well. So I don't want to, go too deep into this, but OB3 is now allowing a deduction for tips up to $25,000 of qualified tips in traditionally tipped industries. I think the two key terms there are qualified tips and traditionally tipped industries. So qualified tips must be voluntary. So a lot of times if you're out at a restaurant and you see at the bottom of the check, it says your gratuity of 18% was included because your party was over 6 individuals. That is not a qualified tip, and that would still be taxed for that individual because that's not voluntary under the way that the code was written. The other key term here is the traditionally tipped industries. We are expecting a list to be available in the beginning of October to list out occupations that are traditionally tipped. These are going to be, our hospitality and our service industries. They really want to make sure that they're closing the loophole. So now all of a sudden, the nurse at your doctor's office is not being paid in, quote unquote tips. So they're going to make sure that they really clearly define what that is to make sure that there is not any, anyone taking advantage of, this new threshold. This does exclude highly compensated employees with a phase out if your AGI is over 300,000. And you can claim this whether you are itemizing or not. And this is going to be available from 2025 until 2028. And with the deduction for overtime pay as well, Hayden's going to touch on this a little more in depth, I think. But OB3 is allowing a deduction for overtime pay of up to $25,000 if you're filing a joint return, $12,500 for an individual return. Only the overtime premium qualifies for the deduction. So if you, are getting paid time and a half, only that and a half is what's going to qualify, not the base rate that you are typically paid. So that is something that is going to have to be tracked. Exact reporting is going to be required beginning in 2026 for the 2025 tax year. Obviously, mechanisms weren't in place for the first half of the year to really track this. So OB3 is allowing employers to use any reasonable method to estimate the overtime and the tips for reporting for this. So we're expecting to see a lot more come out on how this is going to be reported. And this is something that I think we're going to be seeing a lot of those payroll providers, the ADPs and the Paychex kind of taking the reins on this one. Our 529 accounts, the definition of qualified higher education expenses has been amended to include K-12 homeschool expenses and post-secondary expenses. So if you have a 529 account set up, you can now use that for primary school. If you're sitting for the bar exam, the CPA exam, something like that, those expenses will now qualify for your 529 accounts. It's also going to include fees, books, equipment for apprenticeship programs. So not, a traditional college program, but if you're going to a trade school or something like that, those expenses now qualify as well. And the per beneficiary amount for the cash distributions has been increased as well. And this is effective as of July 4th. And then the Trump accounts, still waiting for a lot more guidance on what is going to happen here. But what we do know is that each account is going to be seeded with $1,000 for any child born after 12/31/24 and before 1/1/29. These are going to be classified as IRAs for the benefit of children 18 and under. And then, parents, family can make annual contributions up to $5,000 a year. And distributions can start after the beneficiary turns 18. Waiting to see more concrete guidance on this surrounding the deductibility of contributions, how distributions, will actually be carried out. So more to come on this front as well. And then I'm going to turn it over to Maria for the next polling question.
Okay, everyone, which which stadium would you like to travel to that the Bills are expected to play this season? So take a look and see where you guys want to travel to see the Bills. Everyone's responding very quickly to this one. Somewhat of a trick to it. So let's see who catches on. I might be giving it away by saying that, but I had to look it all up. I wouldn't have known this, so. All right, we're about 85% participated. So the quote unquote correct answer is Levi Stadium, because that is where the Super Bowl is being played in February this year. So that was technically what I was going for. So hopefully we'll be at Levi Stadium is the home, as many of you know, to the San Francisco 49ers. So okay, so I'm gonna end the poll and we'll turn it back to Hayden.
Wonderful. Thanks, Maria. Good morning, everyone. My job today is just kind of go over sort of a cleanup. I'll be talking about some international updates, some things that changed there, some of the tax credits that are mostly going away, and then just a couple of other provisions. So I will be brief. I may not say everything that's on all of the slides, but it will be there for your reference. So the first section I'll get into is the changes to some of the international areas. One of the major changes was to GILTI. It is no longer called GILTI. GILTI was an acronym for Global Intangible Low Tax Income. It is now called the Net CFC Tested Income. I will spare you the nitty-gritty details, and if you have no idea what GILTI is, then you probably don't need to worry too much about this. But for those of you that are some of our cross-border clients or related in some way, essentially what's happened is the GILTI regime, as well as one of the other regimes that I'll get into in a moment, which were primarily targeted at intangible income. So the idea behind these was that if you have intellectual property, quote unquote, that you were moving outside of the US. They wanted to punish that. So hence the intangible. So the real change here was that they used to allow a deduction for 10% of the asset investment. So essentially, they allowed you to have a 10% return on investment in another country if you owned a controlled foreign corporation, tax-free. But now that 10% business asset investment allowance has been essentially eliminated. So now what we're looking at, instead of a tax on intangible income, we're essentially just looking at a tax on not doing business in the US. So that's kind of the primary change there, is that the GILTI in essence still exists. There's still a tax for US owners of foreign corporations that are controlled by US people. However, the way that tax is being calculated is slightly different, which I think is intended to be indicative of sort of a change in kind of the foreign policy that they're working on, and of course, an attempt to bring in more revenue. Another big change for GILTI, which is no longer called GILTI, it's now called net CFC tested income, is we used to be able to take a foreign tax credit of 80% of the foreign taxes which were paid by the foreign corporation, but now we can take 90%. So some of the offset, we lost that 10% deduction, but then on the other hand, we got access to another 10% of the foreign tax credits. Obviously, this is going to pan out differently in all the different situations, but I think this is a fairly good change depending on what type of business you're in. Obviously, if you're in an asset-heavy industry, this isn't as beneficial for you. Another change here was the expense allocations. I'm not going to get into the detail of this, but essentially there are changes to the deductions that are allowable and allocable for CFC tested income. Again, this is really getting into the weeds. So if you have interest in it, it is here for your reading, but it's something that we will deal with more directly as we actually work on preparing Form 5471. Another big change, and this is basically the inverse of GILTI, it was to the FDII regime, which is foreign derived intangible income. If you want to think of GILTI as a tax for having a corporation outside of the US, the FDII was an incentive to export into different countries from the US. So essentially a benefit to doing business in the US. Originally in the regime, there was also a sort of an adjustment for qualified asset investment. That has also been removed. So in both these instances, we're removing the intangible portion of this. So this is now called foreign derived deduction eligible income. So it is income derived from foreign sources that is eligible for a deduction. And the rate of this has changed so that instead of the effective tax rate of being about 13.125%, the effective tax rate now will be closer to 14%. And so that is in contrast with the income tax rate of about 21% for traditional corporations. Another change in this area in terms of international was the base erosion and anti-abuse tax. This is a tax that only applies to consolidated groups with over 500 million in revenue, generally speaking. So it's a fairly nuanced group, and it has to do with transactions between related parties. So essentially, it's a transfer pricing tax trying to keep money in the US. The main change was that there is an additional 0.5%. So the new beat rate has increased from 10 to 10.5% beginning on January 1st, 2026. One of the major changes in terms of the whole GILTI CFC sort of regime was the downward attribution. And this is a highly technical area, but basically during the Tax Cuts and Jobs Act, they eliminated Section 958B, And what Section 958B did is it essentially kept that domestic subsidiary from being considered to own that foreign subsidiary. It's probably strange to think about, but basically without Section 958B, because that foreign parent owns the foreign subsidiary, the domestic subsidiary is considered to own the foreign subsidiary for reporting purposes. If none of that makes any sense, don't worry. Luckily, it is gone with OBBB, and Section 958 has been reinstated. So there's no longer that weird attribution rule between brother-sister entities. New with the OBBB, however, is a new section called 951B. And essentially what it's doing is it is broadening the scope of who can hold a CFC and who can be subject to subpart F and guilty, where there used to be a little bit more of a tighter circle around foreign controlled US entities. Essentially now if a US entity, which is controlled by foreign shareholders, owns a foreign corporation, we're going to need to do a little bit more digging, and we're going to need to do a little bit potentially of extra work to see if this is going to be a CFC to this foreign controlled US shareholder. And this is just another, essentially all of these are ways that the US is trying to deter money and taxes from being kept outside of the US. I'm going to do a hard pivot here, and this is where we're going to get into some of the sort of mishmash of other items that we just felt were important to include. The first thing is just state conformity with the OBBB, but really with any federal act. Obviously, in the US, we have 50 states. They all have different rules. It's helpful to think of the states in three big categories. So there's a group that generally has a role in conformity, which means they adopt all the changes as they occur, unless they decouple. So basically, we're in unless we say we're out. You have static conformity states, which are states that adopt the Internal Revenue Code as of a specific date. So for example, as of 12/31/2025, maybe a state really likes the OBBB and they've decided as of that date, we're completely coupled with the IRS, and any changes after that, they would have to provide additional guidance to. And then the third group is the selective conformity states. And these are the ones who basically pick and choose what they're going to comply with for their state tax rules as it pertains to what the IRS sets forth. A common one is bonus depreciation. A lot of states don't conform to that. But yeah, so this is just something to keep in mind, especially for our multi-state entities, which is that not all the states conform, and they all conform or don't conform in different ways. Another major section that was targeted in the new tax law was the energy credit section. I am not going to read through each one of these for the sake of time, but as basically one of the larger sort of cuts to the tax law as we knew it was that a great deal of the energy credits were eliminated. Particularly close to home in the news were the two personal credits for clean vehicles. So the new and pre-owned vehicle credits are gone. And there's also a myriad of other business deductions, which all are sunsetting either as of the date that the law was signed into place, so July. Many of them are the end of 2025. And then some of them have a June 30th, 2026 end date. So those are just some dates and things to keep in mind. In addition, some of the energy credits were not cut and they were improved. The advanced manufacturing production credit was mostly retained. There's not a lot of changes there. So this is essentially what it looked like beforehand, with some changes to the mineral phase outs. The advanced manufacturing investment credit, which relates to semiconductors, actually increased from 25 to 35%. And the clean electricity investment credit eliminates the credit for solar and wind in service after 12/31/27. So this is a list of credits that are mostly untouched. Basically, the ones from the previous slide. And then basically the concepts that related to these remain the same. So bonus credits are still available, and there's still the ability to transfer credits as part of larger packages. With that, we're going to move to the third polling question, and I will then move us into our last small section.
Hi, everyone. Just a reminder, if you are looking for CPE credit, you need to answer all 4 of the polling questions as well as complete the survey, which will automatically launch at the end. Even if you don't need CPE credit, we appreciate any feedback so we can improve these events going forward, especially if you have any topic suggestions. So we'll give this another minute. And also just a reminder, there are no questions, but if anyone does have any questions, they can put them in the Q&A section and we're happy to answer them for you. All right, I'll give this another second. Okay, I'm gonna end the poll and we'll turn it back over to Hayden. Thanks, everyone.
So the last small section I'm going to cover here is employer provisions. And a lot of these relate to other laws, but we just want to make note of what the employer's responsibility becomes as it pertains to some of these. So tip income, there's not a huge change here, as technically tips were already reported on Form W-2, but it will be the employer's responsibility to report all tips on Form W-2, because they will now not only need to be reported for taxable income, but there's, of course, now a deduction which is available to tipped employees. The IRS is going to be publishing a list of occupations, like we said, so we will continue to keep an eye out for that. And of course, there will be relief for 2025, since we're already 2/3 of the way through the year, but we'll continue to look out for guidance as reporting will likely change as of 1/1/26. The FICA tax tip credit is also being expanded. So it typically used to only apply to the food and beverage industry, but it now is expanded to other groups which are typically tipped. The largest of that being the beauty services, so barbershops, hair and nail salons, etc. The FICA tax tip credit is essentially an incentive for employers to report their employees' tips, because they receive a credit for the FICA, so they don't get dinged on that 7.5%. So it's an encouragement for employers to encourage their employees to properly report tips, and it has now been expanded outside of just the food and beverage industry. The other provision, Amanda already touched on this, is the overtime provision. This is unlike the tip provision. This is something that isn't normally reported on Form W-2. So there is basically a grace period, which Amanda already touched on, for 2025, but beginning in 2026, again, we're waiting for additional guidance. There's going to need to be some reporting done on what that extra 0.5% of overtime is, how much is paid, how much of the employee's W-2 wages or Form 1099 income should be allocated to that. And that will, of course, be reported to the IRS so that they can cross-reference this for deductions. Again, we're expecting to see a lot out of some of the payroll providers in terms of this new law. Form 1099 miscellaneous. The threshold for filing has increased from 600 to 2,000, which is great, and it will be adjusted for inflation moving forward. Another change is that the publicly held corporations will now have a 1 million limit on compensation, which is deductible for tax purposes. So of course, they're allowed to pay their shareholder or their executives as much as they want, as long as it's determined reasonable by the SEC. And but there will not be a tax deduction for anything over $1 million for these covered employees. Finally, there have been a lot of I don't actually think this is the last slide, but there have been a lot of questions about the meals. We're still waiting for a lot of guidance about how this is going to play out. There's a lack of clarity on exactly what these deductions and add backs are going to look like, but the gist of it is essentially that they're looking to sort of clamp down on what is a deductible meal. So the deduction for in-house eating facilities is becoming fully non-deductible. And there are questions and a little bit of a lack of clarity as it pertains to snacks, restaurant purchases. We're expecting some of these things will remain non-deductible or become non-deductible, and some will remain deductible. So we'll keep an eye out for future guidance on that front. The employer-provided childcare credit. This is a great increase, great encouragement to employers. It's increased from 25 to 40% and 50% for eligible small businesses, and increases the yearly cap from 150,000 to 500,000. So this is a massive change. Obviously, 25% of 150,000 and 40 or 50% of $500,000 can be a significant increase. So if you provide childcare for your employees, this is a great opportunity. And finally, the paid family medical leave credit has been made permanent, and it allows the employer now to elect to take a credit on the percentage of wages paid or the percentage of premiums paid. So this, again, is an incentive for employers to help with some of their employees' medical leave needs, and providing with the IRS sort of subsidizing a portion of that. With that, I will turn it back over to Maria for our final polling question.
Okay, everyone, last polling question. And again, just a reminder to complete the survey at the end. And a big thank you to Amanda, Megan, and Hayden for presenting today. There are a ton of slides, over 50, and they did a great job of condensing it and keeping it to the hour. So again, thanks to everyone. If you have any questions, their contact information will be provided in a follow-up email if you want to reach out. And of course, any advisor here at Lumsden and McCormick can help you out. And if you bear with, oh, we do have a question. So hang on a second here. Can employers still buy lunch for employees on the company but not deducted, or take a client out to dinner but not deducted? Thank you. So does anyone have an answer to that?
Yes, so you still will be able to do that. You just might not be able to get a tax deduction, at least on the employee side. We're kind of going to see, what happens with that new guidance around meals. There's been a lot of conflicting where it's like, just if you have, a cafeteria and you're providing meals to employees, or it would be everything from snacks to coffee. That would no longer be non-deductible. So there's a lot of confusion in the industry right now, but you can definitely still pay for it. It's just whether you will get a deduction or not is kind of, a little up in the air and waiting for their guidance.
All right, great. Hayden, can you go to the next slide real quick? So the answer, I thought we would just throw this in last minute. It is actually a horse. There's actually 2 men on horseback. And if you see where I'm actually, yeah, Hayden has the cursor there. They're right above there. So again, just some fun with the City of Buffalo seal. So okay, great. Again, thanks to everyone for attending. We'll be following up with a recording. The slide deck will also be available on our website if you want to pull any information from it, and reach out again with any questions. And I hope everyone has a great Wednesday. Thanks, everyone.